Hi everybody. I know that for many of you, the recent market volatility has made investing feel like a risky game. Stock market crashes can be devastating, and if you're feeling uneasy, you're definitely not alone. In today's video, we're going to talk about how to minimize the risk of being caught off guard during a stock market downturn and how you can safeguard your investments even when the market takes a dive. Today we will discuss two popular methods to predict a market crash or recession. They are 1. The inverted yield curve, which is the spread between the 10-year bond and 2-year bond yield curve. 2. The spread between the VIX3M and VIX curve. Now here's a chart showing the S&P 500, the 2-year bond and the 10-year bond yields. The S&P 500 or SPX is represented by the blue graph. The 2-year bond yield is represented by the orange line and the 10-year bond yield is represented by the red line. It is the conventional wisdom that when the 2-year bond yield is above the 10-year bond yield, that is a sign of an impending market crash or recession. That phenomenon is called an inverted yield curve. During July 2022, an instance of inverted yield curve happened. However, the market crash didn't happen until 2025. Granted that we saw two major market drops in August 2023 and July 2024 during the inverted yield curve moment. However, the market quickly recovered and yet the yield curve remained inverted until a real major crash took place from February 2025. Practically, the SPX was in a bull market from July 2022 till September 2024, even though the yield curve was inverted within that span of time. It's obvious that this indicator has not been working well lately due to some inherent changes systemic within the economy. That would be a topic that we will discuss next time. From September 2024, the yield curve became normal and didn't even display any inversion, and yet the market crashed in February 2025. Clearly, this yield-based indicator has been quite disappointing. It did work some years ago, but seemingly it has lost its mojo lately. Now we shall dive into an alternative, which is a volatility-based indicator. It consists of the SPX, VIX, and VIX3M lines, with the SPX in blue, the VIX in orange, and the VIX3M in red. We can observe that when the VIX3M is above the VIX, the market will most likely go up. I have shown two examples of region where being long in the market will likely be profitable. Now let's zoom into a focused area to study the behavior of the VIX pair. This area will show how the gap between the VIX and the VIX3M correlates to the market price behavior. Here's the expanded view of the focused area. The gap between the VIX and VIX3M shows a band of steady in-between space starting from the beginning of the chart to July 17, 2024. That indicates the market will unlikely turn disastrous within the window of time. The SPX shows a mostly healthy bullish movement, although with some small and palatable dips. As it approaches July 17, 2024, both charts steepen up and the gap narrows. That is a sign for us to prepare for every possibility by either reducing long position or do some hedging. True enough, the SPX soon turns sour and experiences a serious drop in price. Now let's focus into the chart beginning August 6, 2024. The crisscrossing between the VIX and VIX3M line in the yellow zone is the signal that the traders should really focus on the ongoing geopolitical and geoeconomic situation, be prepared to cut off and run, and be invested lesser than usual. The spike in the orange line exceeding the red line is highlighted by the red oval region, and that should be a sign that the investor should take to the sideline to observe more instead of trading. That's all for now. If you like my sharing, please like, subscribe, and ring the notification so that you won't miss out any important market update. Thank you, and see you at the next one.